Hello, and welcome to Advanced Asset Management Advisors Quarterly Market Commentary Review. I'm Bob Baker, President of Advanced Asset Management, and joining me today is Phil Volker, my business partner and AAMA's Chief Investment Officer. Hey, Phil, how are you?
Good. Good morning.
We're both pleased to be here today and to be able to talk about our current market commentary. But before we do that, I thought it would be appropriate to take a couple minutes and review who AAMA is. AAMA is an independent investment advisory firm, and our work is fundamentally rooted. We seek to add value by tilting portfolios toward attractive market segments through our market pricing and sector valuation investment discipline. Our highly experienced investment team, with over 30 years of average experience each, spends a lot of time and effort in evaluating the stock and bond markets. We also believe we deliver a team approach which allows advisors to speak directly with me and Phil. We provide collaboration and an investment process that is easy to understand, track, and most importantly, discuss with clients. So let's get into today's presentation. And we've all seen a number of current headlines. And I think we're all trying to figure out if some of these are fact or fiction. Phil, do you want to add your perspective on this?
Sure. As you mentioned, Bob, we get inundated with headlines daily, and a lot of it through the financial media. It's important to put them into perspective. A couple just to point out: last March, there was a declaration, if you will, of a bear market. That was after the market was down 20%. So it was a little bit late in planning for it. Investors that sold out were probably disappointed at that point because it was somewhat of a low in the market. And just recently, there's been a declaration of a new bull market. So it's a similar situation where now the market's up 20% from its December lows, and it's been declared a new bull market. That very well could be, but it could also be a correction in an ongoing bear market. So you just have to put the headlines into perspective. Another set of headlines that has been consistently visible over the last 15 months is the Fed pivot away from raising interest rates. And this started, a year ago in the summer, where many people that were interviewed on some of the financial media were suggesting, well, the Fed was done raising rates, they've done enough, they're going to pause and then pivot to lower interest rates. Each one of those instances, probably about four of them now, each one of those instances was reversed and those hopes were dashed. The bottom line is that the Federal Reserve remains resolute in their fight against inflation. They have said consistently that the worst thing they could do is to stop too early. And that's based upon the experience from the 1970s and 80s. So, bottom line, take the headlines with a grain of salt and base your decisions on facts and good analysis.
That's a really good point. So let's take a minute and look at some facts and actually take a evaluation of the headlines and put them in the perspective of the market averages. And this goes back about 18 months. So if you want to kind of summarize this, Phil, that would be great.
Sure. As everybody knows, 2022 was a bad year for stocks and bonds. The only safe place to be to generate any return was Treasury bills, where you earned 1.5%. And so far this year, the headlines again have been touting the strength of the market. And in fact, the NASDAQ has had sort of a record 6-month run. But that run in the NASDAQ has been concentrated in 6 or 7 companies. And in fact, the S&P has benefited greatly from those 6 or 7 companies as well. And the best way to look at the breadth of the market is to compare the equal weighted index return so far this year at 6.9% versus the cap weighted index at 16.9. So that's another way to say that is, the average stock is up 6.9%, but The cap weighted average, having been influenced by this handful of stocks, indicates 16.9. The last thing that's sort of interesting is the 18-month returns. Some of the gains have been spectacular this year to date, but it doesn't mean that they've erased the decline. Probably the best example is the Renaissance IPO, down 57, up 32, means it's still down 43% from its high. So it's sort of the mathematical catch up game. If you lose 50%, you have to have a 100% gain to get back to even.
All really good comments, and what those 12 stocks of the S&P made up about 60% of the 16% gain. So that's just significantly concentrated in those 12 stocks. So we've had a lot of hype here recently about artificial intelligence, and as we've talked a number of times internally as a firm, that you know a lot of this really started 60 years ago, and it's hard to say that, but when 60 years ago, as computers became more integrated into our daily lives and business lives, and this has developed a lot of hype really in the last 5 or 6 months.
Right. And as you said, Bob, the integration of computers is the pure definition of artificial intelligence. They've always been programmed by somebody to tell them what to do. And, the hype today is the speculation that these computers are going to be able to learn themselves, but still they have to be programmed to process that learning. So our view is that AI is going to continue to generate productivity gains, helping the economy grow efficiently. But the speculation in the field today, we think, is excessive. If you just look at two stocks, Google or Alphabet is one of the big players with software and database, and NVIDIA, a big player, speculation on hardware generation. And if we look at the valuations, NVIDIA is, in our book, extremely overvalued, PE of 220, forward PE of 56, price to cash flow to 207 times. So the price of NVIDIA today is discounting a lot of growth in the future. Google, not nearly as overvalued as NVIDIA. It's at the upper reaches of its historical range in pricing, but it's not off the charts like NVIDIA. So, forced between the two, we'd rather own Google than NVIDIA.
Sure, and as artificial intelligence becomes further readily available, we're all going to have to try to figure out whether the AI that's being seen on the public internet sites is accurate or whether it's inaccurate, and that's going to create a whole nother issue to try to figure out in the future. Now let's take a minute and shift towards the economy. Phil, take a couple minutes and walk us through this slide, please.
Everybody who pays any attention to the financial press knows that a recession has been predicted at least for the last 9 months. It's been one of the most widely predicted in history, and for good reason. All of the tried and true recession indicators are screaming recession. Most of those tend to be measurements of the yield curve or the trend of money supply growth. And the yield curve has been inverted various places on the curve at least since last fall. We would suggest that there are other factors keeping the economy resilient at this point, and that the yield curve may not be the best indicator for recession as it has in the past. The other largely accredited recession indicator, and that's the money supply. Money supply has now shrank for the last 12 months. Typically, that precedes a recession. But we have to remember that in the 2 years before this last 12 months, money supply grew excessively. So if you look at the 3 year growth in money supply, it's still averaged about 11% a year over the last 3 years. So The things that have been keeping the economy bubbling along, first of all, government spending. Government spending went off the chart during the pandemic. It's settled back down, but today it's at 25% of GDP, and that's unusually large. Normally it's about 19% on average, but the 25% typically happens in periods of recession, like in the early 80s or during the great financial crisis. So normally these levels of spending would be in place to counteract some of the negative effects of a recession that's already in place, but we've got them cooking along right now without the economy in a downtrend.
So federal spending is alive and well and robust.
Right. Um, another factor is the easy monetary policy of the last 15 years. And quantitative easing had taken the Fed's balance sheet up to nearly $9 trillion. Today, it's still $8.5 trillion, which is 2 times what the normal baseline growth would be, which is 4.4% a year. And it's also twice the size that's estimated as the appropriate size for the Fed to carry. I mean, it was less than a trillion back in '08. Now the estimates are that 4 trillion would be sufficient size for the size of the economy. It's hard to imagine it being 4 times, but even so, twice any of the numbers that suggest what it should be. That balance sheet keeps liquidity in the system. Another measurement of recessionary trends is the employment trend. That's a lagging indicator, but conditions in the labor market today are stronger than normal. If you look at participation, you look at the demand for labor, small businesses that consider difficult to fill positions is still elevated. Job openings per unemployed is still elevated. So there's a lot of cushion in the labor market that suggests that the labor market will continue strong and help the economy avoid a recession.
And it appears like the consumer is alive and well and spending away also.
Well, it is. It has been. It's been forced to pay higher prices for things, but it's chugging along. I mean, it's grown at 7% annualized relative to history of 5 to 6%, and it's still grown at 6.7% over the last 12 months. So the consumer to date, on a nominal basis, has been keeping pace, getting less for their dollars, but keeping pace with spending.
And that kind of brings us full circle around to interest rates.
Yeah, the interest rate market is interesting. We alluded to the fact that the yield curve is inverted. 2 year at 5%, 10 year we'll call it 4%, which it just yesterday was at 4%. So it's still inverted by 100 basis points. And obviously, the short end of the curve is influenced by the Fed. They're pushing rates higher to stifle inflation. And to date, the 10 year, which is determined more in the marketplace, has refused to follow that higher and seems to be pricing in the potential for the economy to slow down somewhat. But being back at 4% today is part of a trend that we think is going to develop, and that is we don't think, first of all, that the Fed is going to get inflation down to 2%. So pick a number. Let's say it's 3.5. That settles in as a intermediate to longer term inflation level. In that instance, you're going to have 10-year yields at 4 to 5% to compensate for longer term inflation. And so you could see the yield curve flatten as the Fed starts to back off a little bit. But we think that the longer term segments of the yield curve are going to be relatively stable to inching higher as a more persistent inflation settles in somewhat modestly above the Fed's 2% target.
Sure. And what higher short-term rates and higher long-term interest rates have significant impacts on the economy and on investors. You want to take a minute and talk about that?
Sure, the 5% risk-free rate in money market funds, T-bills, it's like Christmas in July for investors. It's the first time we've had that since early 2000s. So it's a positive for savers, retirees that live off of interest income. So in some respects, it's a bolstering of savings and spending for those that are savers. The downside to higher interest rates, one of the most significant is the Treasury interest expense. First quarter annualized was just under 1 trillion annually, and with the continued increase in rates, the 1 trillion of new debt issuance since the debt ceiling was lifted, certainly it's going to be over a trillion annually real quick. And that is a negative on future government spending, which, as we mentioned, is running at 25% of GDP. So something's probably going to have to give on that front so that the Treasury can pay its bills on interest. The most significant impact from an investor standpoint is that corporations are paying higher interest rates. So the more leveraged the company, the higher their debt, the more they're going to be affected by it. But across the board, any borrowing costs for the corporate sector are rising, and therefore, the default risk is also rising for the highly leveraged borrowers. One other off the cuff point is I just noticed this morning that credit card interest rates are now up to 22%. And a year ago, that was like 15, 16. So, as opposed to moving from 2 to 3, those rates have gone from 15 to 22, which for those people that are using credit cards to live off of to cover the higher inflation cost of food and rent, et cetera, they're going to be squeezed even further.
All results of higher interest rates. It's amazing. Now let's take a couple minutes and look at our what I'll call our traditional fundamental valuation of the market and the sectors. And I'll let you walk through a couple good sectors and a couple overvalued sectors, Phil.
Yeah, as perspective, we should point out first of all that the S&P 500 is trading at its 80th percentile of historical PE ratios, which means that it's near the top of its overvalued range. It would be great if that were below 50, but it's not. It's in the overvalued range. Forecasted earnings are to grow 11%, which implies a trough in corporate earnings, this quarter, next quarter, which the market may be anticipating a little bit. But the bottom line is that the market's overvalued. And if we look at a couple of sectors, first of all, healthcare as an example, it's at 51st percentile median. Actually, today it's a little bit below that, but 17% earnings growth. So it's the one sector that's trading below median valuation with double digit earnings growth projected. And price volatility, earnings volatility is all less than the market, 74, 94, 39% of the market. So that sector is quite attractive to us. Low volatility, good fundamentals, good earnings growth. If we look at some of the sectors that are less attractive, we'll see consumer discretionary, consumer staples, technology, all in the mid 80s as far as valuation goes. There's some good earnings numbers on technology and discretionary, but they're in the overvalued range. And their volatility, in particular over the last year, is high relative to the market, 40% higher than the market. The other one that sort of jumps out here, not so much as overvalued, but we'll say unattractive, and that's the financial sector. It's below median valuation. You look at that and say, well, gee, they're cheap, but not really, because earnings forecasts are flat, and the projection is that the banks are going to have to raise their loss reserves in anticipation of higher losses in commercial real estate. And we'll also notice that price volatility 120 times or 120% of the market over the last year, and earnings volatility over the last 5 years 70% higher than the S&P. So that's a reason we are underweighted in financials when on the surface it may look attractive. The other sector that we're somewhat overweighted in is consumer staples. And look at that now and say, gee, it's in the 85th percentile. True, but does have double digit earnings growth projections. And if you look at the volatility price, about three quarters of the market, and earnings volatility, 20% of the market. So even though price is overvalued, the risk in the consumer staples sector is much lower than some of the less attractive sectors.
So, kind of boiling all those factors down, Phil, give us a summary of the equity and the fixed income portfolios today.
Yeah, the equity portfolios remain focused on large cap with a tilt towards defensive sectors. And we have a focus on earnings stability, growth, modest growth, and stability. And I think most important in today's environment is balance sheet quality. More highly leveraged companies that are faced with rising interest costs are less attractive to us. Those with solid balance sheets and less refinancing risk on the debt side are certainly more attractive. And on the fixed income side, we're still short average maturity, just over 2 years, high quality, basically 100% treasuries. Couple factors here: the rising interest rate environment will raise the default risk for low quality issuers, so we have no high yield exposure. And with the trend of rates potentially remaining volatile and the curve flattening, that would favor a short maturity structure. And once that starts to flatten out, there may be an opportunity to lengthen maturities, but we don't think that time is today.
As always, a lot of cross currents in the equity and the fixed income markets. Phil, thanks for detailing the data and reviewing our market valuations. As always, we encourage you to call us if you have any questions on our portfolios or how our work could be effective in assisting you in meeting your clients' investment goals and objectives. My phone number is listed. Aaron Plaskow, our national sales manager, his phone number is also listed in both our emails. So please don't hesitate to contact us. We'd love to answer any questions you might have and explain our work and how it could be effective within your portfolios. Again, thanks for joining us.